Welcome to this video to help you prepare for Virtual Classroom number 2. We're going to be covering financial instruments. Now, we're extending the background information about NITs that we started in Virtual Classroom 1, so make sure you've got that background information available to you from the Virtual Classroom page. So NITs develops and distributes software for timetable scheduling for transport companies. The software can be used in Australia and overseas. NITs has a functional currency of the Australian dollar and it has a 30 June year end. To enable its expansion, NITs is acquiring some significant new equipment and services from a French company called Bello, and they're purchasing it for a price of €5 million. So here we've got some issues to look out for, and we're looking at the financing that they're going to undertake in order to acquire these assets. So NITs needs to raise some funds to finance this acquisition from Bello, and they've got two different options available to them. So for starters, I'm just going to explore option 1. So in order to pay that €5 million, they're going to raise $7 million in Australian dollars from the issue of 700,000 preference shares on 30 November X3. And that will give them sufficient funds to raise the finance to pay the €5 million to Bello. Details of this preference share issue are that they're going to incur issue costs of 700,000. There will be a 6% fixed dividend payable each year, subject to NITs having sufficient liquidity to declare and pay the dividend, and the preference shares are redeemable in cash at the option of NITs at any time up until 31 December X8. Otherwise, they'll mandatorily convert to 700,000 ordinary shares. So the first part of the task is to determine how the preference shares will be classified under IAS 32, and you need to support your answer with references to that standard. The first thing to do is to determine how the preference shares will be classified under IAS 32. So remember, IAS 32 is where we go for the definitions of financial instruments and for the accounting for equity instruments. There are 3 possible classifications for financial instruments under IAS 32. Firstly, financial assets, financial liabilities, and equity instruments. In this instance, NITs is raising finance, and therefore we know that the preference shares will not be classified as a financial asset. Financial liabilities are defined in paragraph 11. The key thing to note is that for a financial instrument to be classified as a financial liability, there must be a contractual obligation. Equity instruments are also defined in IAS 32 in paragraph 11, and the wording is about a contract that evidences a residual interest in the assets of an entity after deducting all of its liabilities. Determining whether the preference shares are financial liabilities or equity instruments is therefore based on the definition of a financial liability, because if it's not a financial liability, it'll fall into that residual interest, which is equity. So let's take a look at this for the preference shares. So looking at the terms of the preference shares, we need to establish whether NITs has a contractual obligation and whether the conversion is for a fixed or variable number of ordinary shares. We've set up the answer in a table so that we can analyse each item against the relevant criteria. And using tables can be helpful to set out your answers, particularly in an exam. So it's a good opportunity to be practicing this sort of setup approach as you work your way through the FID module units. So for starters, I'm going to look at that 6% fixed dividend per annum. Now, it's not a contractual obligation because it's subject to NITs having sufficient liquidity to declare and pay the dividend. So there I'm using the facts from the scenario to help me come to that conclusion. Next, that they're redeemable in cash at the option of NITs at any time up until 31 December X8. So again, no contractual obligation here. And that's because the instrument is repayable only at NITS's discretion. So there's no obligation to repay that initial investment. And otherwise, they'll mandatorily convert to 700,000 ordinary shares. So where a non-derivative instrument, so here the non-derivative instrument is the preference shares, they convert into a fixed number of shares, and we're told 700,000 shares, then 32 indicates that the instrument is equity. So perhaps go and have a look at paragraph 16 little b. As there is no contractual obligation, this indicates that the preference shares will be classified as an equity instrument. However, in order to classify it as equity, we also need to satisfy paragraph 16 little a and 16 little b. And in the live Q&A session, we'll expand on these requirements for contractual obligations further. So here you can see in this column, we don't have contractual obligations. So therefore, given we've satisfied those two paragraphs, which I encourage you to go and read, it's an equity instrument. So the preference shares that are used to raise the funds to pay Bello, they're going to be classified as equity. So that means when we do the journal entry, if we were going to be doing that, we know that the credit will go to an equity account rather than to a liability account. Okay, so here is a solution. You may want to pause the video to have a read through these words that are included in your slides. Okay, the next part of the task is to explain how each of the financing options will be accounted for, ignoring any possible implications under IAS 23 relating to borrowing costs. So no calculations or journal entries, just an explanation. So looking at option 1, which were our preference shares, I'm going to have a go using a bit of a diagram here to explain the accounting treatment. And sometimes this type of timeline can be good to help you understand the facts, but also so you can lay out your answer in a slightly different way, and you might find that in an exam will give you a better exam result because it's clearer for you to see and you can explain yourself well here. So the accounting, we need to look at the initial recognition, what happens. So those preference shares would be recognised in equity at their fair value at the date of issue, less any transaction costs. So equity is a credit item, transaction costs are a debit item, so it would be a net credit going through equity. Now under IAS 32, we're told that we don't remeasure the value of equity. So that means it's not as though we need to do fair value adjustments or anything over the life of these shares. So nothing's remeasured. When we pay the dividends on those shares, when we've got sufficient liquidity to do so, we'll be recognise those dividends in equity. So that means it's not an expense in P&L. So it would be an entry like credit cash debit dividends declared. Then when we redeem them, remember NITS has got the choice to redeem them, or if they mandatorily convert, again, that's going to be accounted for directly in equity. So that means removing it out of the preference share capital account within equity and either paying it back in cash if you're redeeming it, or putting it into another equity account if they convert into those ordinary shares. So that's the explanation there. Moving on to option 2, because we need to explain the accounting for this one, let's just read through the facts here. So this time they're going to take out a 5.5 million euro loan from Argent Bank in France. The loan has the following features. It runs for a 5-year period from 30 November X3 to X8. There are no principal repayments, so it's interest only, and the full amount will be repaid on 30 November X8. There are transaction costs of 500,000 in setting up the loan, so that's a debit value, transaction costs. The interest rate is 2.8% per annum, but when you factor in all of those transaction costs, it makes the effective interest rate come up to 4.8936%. We've also been told that the loan will be used to finance the equipment purchase. NITS intends to make interest payments and then repay it at the maturity. There's no measurement mismatch regarding the loan, and the loan is not managed as part of a portfolio for short-term profit taking, and there's no documented group of financial liabilities managed as part of any risk management or investment strategy. So this is all to do with the classification of this loan, which we'll look at shortly. But so here are these key terms to deal with at the moment. So let's look at explaining the accounting. So what we need to do is to look at what IFRS 9 tells us. So we've got a borrowing. So the two different categories that we've got come through from IFRS 9. So we know under IAS 32 that the financial liability exists in relation to this borrowing. So IAS 32, remember financial assets, financial liabilities and equity. The borrowing is a financial liability. Then we move into IFRS 9, which then requires us to look at how we're going to categorise that, because that's going to then drive the accounting entries that we're going to make. So what we're looking at here, we've got two choices: fair value through P&L, that we've abbreviated on the screen there, and amortised costs. So firstly, we need to look at, with fair value through P&L, could it sort of be categorised that way? And we look at that firstly as to whether it's held for trading, or have they designated it an initial recognition? So we need to explore that. So if a financial liability doesn't meet the requirements for fair value through P&L, then it will be categorised at amortised cost. So let's go and explore this. So firstly, what would trigger a liability to be measured at at fair value through P&L? Firstly, if it was held for trading. So let's look at the questions here. Was it acquired for selling in the near term? No, we know it's being used to pay the amount for bello, and we know that we're talking about paying it off at the end of the loan term in 5 years. Is it part of a portfolio with a recent pattern of short-term profit making? No, we were told some extra information. So none of these questions really match our facts in our scenario. And it's not a derivative, it's a borrowing, so it's not deriving its value from some other item. So then we look at the initial designation. So let's look at some questions there. Is there a measurement mismatch? That's hard to say. Or is it managed as part of a portfolio? And again, that extra information didn't suggest that any of those were at all relevant here. So that means we're going to be accounting for it under the default category for financial liabilities, which is amortised cost. Okay, so back to our task. We know that we're asked to explain the accounting treatment. So we've got a borrowing, it's a liability, it's a financial liability. It's been categorised at amortised cost. So we need to explain what's the accounting treatment for a liability that's categorised at amortised cost. So remember that the borrowing was expressed in euro. But remember that NITS has an Australian dollar functional currency. So there's going to be some translation issues, but we'll get to those in a moment. So let's have a look at what we need to do. So again, a timeline can help us here to explain what the treatment is. So on initial recognition, we'll recognise that liability at its fair value, less the transaction costs. A liability is a credit value, transaction costs are a debit value, so we'll be recognising a net credit amount. The amortised cost approach is the amount recognised on initial recognition, less repayments made in the period, and this will only be interest until the final repayment that NITS is going to pay at the end of the borrowing period. Plus we add on the accrued interest using that effective interest rate that we saw in the facts was 4.8936%. So the fair value less the transaction costs is the amount that's at initial recognition. So because we're going to recognise it in Australian dollars, that amount will be translated using the spot rate at the beginning of the loan when we first take out that borrowing. Then the repayments, those interest amounts that we're paying, they're going to be translated at spot rate. The interest that's accruing, so the real interest that's going to be expensed at that effective interest rate, that 4.8936% rate, because that relates to the interest expense over the period, we're going to translate that using the average rate for the period. And that gives us the closing balance of the liability in euro, but because it's a monetary item, we need to translate that using the closing rate. So then, because we're using a variety of rates with this euro loan, we'll find that there are some exchange differences, and they're going to be recognised in our profit or loss for the period. So remember, this is a foreign currency transaction, so that's why those exchange differences go through our profit and loss. It's not translating a foreign operation, so we're not going to be using the foreign currency translation reserve. That's not relevant with our net scenario. So that's the end of what we need to do with task A, and in the live Q&A session we'll explore some issues about categories of financial assets and financial liabilities in some more detail.